Good afternoon, everyone. We have two esteemed guests, so I'll shut the bleep up and let them speak. We have David Cullum of northern New York, I guess, north central New York, and the infamous master of hedge funds, Eric of Chicago. Anyway, I'll shut up and pay attention.
Yeah, I'm going to start, dude, just because I'm the troublemaker who created this thing. So we're speaking with Eric Hunsater. In some ways, this is a miracle of social media today because we all met digitally in some bizarre way. Eric, you might not even remember, but we met well before Twitter. I used to ask occasional questions to Saluzzi, who I think you guys are good friends. Is that right?
Yes.
You guys work together close. And he would send it over to you, and then he'd get the answer back. And I remember thinking, who is this guy? And then as the high frequency trader story emerged, your prominence became patently obvious. And so we connect on Twitter. You are not a big consumer of following, I've noticed. Yeah, your Twitter feed is the most boring one I've ever seen, I think. Yeah, I think you follow your mother and father and Joe Saluzzi and Thema Sal, right? And that's maybe Jeff Donovan. Say hi to him for me. And not much else. But we chat on Twitter. So a lot of times late night. Bob, I met on Twitter. Two peas in a pod. So in any event, I am an amateur consumer of fine media and of markets and stuff, and you are the global expert on high frequency trading, in my opinion. So I thought it'd be great if we chatted. So was it 2 nights ago? I kind of threw it out and said, hey, what do you say you do a BTFDtv with us? And you said sure. And so here we are. And so I'd like to get started by asking a simple question of you. When did the high frequency trading actually begin? When did it first start showing up? Around 07? Earlier than that? What's the
2007. 2007.
And that's when Saluzzi started to notice that his trades were running out in front of him and he couldn't somehow keep up with them. Guys like
that? Yep, that's right. Yeah, I've got it right in front of on my screen. Here's a Google Trend Search results for high frequency trading. You can see it.
Oh man!
First pops up.
How many Saluzzi types are there in the world who would have simultaneously started to pick this up? Do you know? Do you have any sense of
hundreds? Hundreds.
So it'd be not thousands. It'd be hundreds.
Well, I mean, pick it up like in the first week or the first month. I would think within the first month, or whenever you're looking at quarterly comparisons, probably you would notice something, and that would be a larger number.
But these are the guys who are trading along for 25 years, and they've got this incredible intuitive sense of how markets behave. And then all of a sudden they just stopped working, right? They just dead cold.
Right. They weren't able to get they weren't able to get the liquidity being offered, basically, is where a lot of the first notices were.
Okay. And so they would go to make a trade, and all of a sudden the trade would disappear.
Or they would try to get 25,000 shares that was advertised, and they'd only end up getting half of that.
Okay. And now here's the question that I've never gotten an answer to. Maybe it's a good place to go early. What is Nanax's role? And in some sense, it's a question: what's your business model? How do you guys come into this? Because you're the world's experts at monitoring this crazy stuff.
We process all the data. It's because I've been processing market data since 1987 when I was collecting it on a floppy drive. So I used to collect all of CME's time and sales data, and I ran a bulletin board service where people could dial up, and they could download tick by tick of S&P futures.
And so did you see the high frequency trading appear immediately, or did you not know what you were seeing at first too?
We weren't looking at data. We were looking at it more like the SEC looks at it now, more in aggregate numbers at the end of the day. Not really, you know, digging into it. Though we occasionally would see, I would see examples of crazy. We used to call them laddering, where the quote would step by a penny a couple times a second. I would see that from time to time back in 2006, but it wasn't really until the flash crash when the thing that really caught our attention of the flash crash was system overload, where there was just way more data than capacity across Wall Street. And that's when those kind of days you kind of set aside to replay and process again a lot, just to get an understanding of where the bottlenecks are and see if you can't make your software perform better. And it was during that time when I noticed that a huge number of a lot of the information on that day, a good 25% or more, you could have just chucked out. It was meaningless garbage. And the deeper I dug, I don't know if you ever watched the movie Poltergeist, but when that guy goes in the bathroom and he finds a little tear on his skin on his face and he starts pulling at it.
Oh, to rip his face right off, right.
Exactly, and it's like that. It just gets worse and worse and more eyebrow raising and blah.
Now,
so
you
that's what brought me to it. The flash crash was.
So for those of you who the flash crash is a distant memory, one of the great ways to experience it is to go listen to that Ben Lichtenstein audio in which he narrates it. And I don't know if you've heard it, but Lichtenstein supposedly is on the floor somewhere. I don't exactly know where he's standing, but he narrates it, and he's going bonkers as it's dropping like a stone. And so just for the people who are not familiar with HFT and not familiar with liquidity, so that the liquidity problem is when all of a sudden you get these air pockets, and all of a sudden there's just these huge drops where there is no buy or sell. In that case, sell. Buy, excuse me, and it makes big jumps down. Is that?
That's interesting you say that, because that's actually not what's going on. It's fascinating. There isn't a pocket. For example, really great example here in this multi-billion-dollar market cap stock. We're looking at about 17 minutes of data. This is between. Can you see my screen?
I can.
Okay, so this is 12:08. The minute of 12:08, and here's the minute of 12:09, and you see this string of dots, and these are all trade executions, and you would think, well, there's just no liquidity there. There's just a big pocket, but when you drill down inside closely, you find that it walked up a penny at a time, and there was a trade all the way up at every level, and most often there's buying and selling every penny along the way. And so with this chart that I expanded here is 2 seconds, 2.5 seconds, 3 seconds worth. So it's not an air pocket, it's just the machines are just operating at this speed, and when they're operating at this speed, they're the only ones participating. And so everybody else on the external to them has no chance of doing anything about it. And so that's what's really going on in these massive moves.
And so before this, like in let's arbitrarily say 04, 05, the trades were being done as fast as the guys sitting in cubicle farms were able to hit the F key.
Here, let's read NYSE Regulation Rule 1005. They were going in 2006. They were going to eliminate the restriction against making a trade in the same stock less than 30 seconds apart from the last one.
Wow, that's not.
So
nice.
2006, the NYSE had a pilot with just one stock, or maybe it was two stocks involved. So before this time, that was the rule. 30 seconds was rule 1005. And so, 2005, 2006 is often hailed as when the market was near perfect as far as execution costs, spreads, you name it. It really is kind of like the model year to get to, and they have these restrictions at 30-second intervals.
And do we know who lobbied to get those taken out? Was that Citadel and those guys? Was that?
It was very, very likely. Right. It would have been EWT, which is before Virtues. That was their name for Virtue. It would have been Chris Concannon's. Those people. Yep.
And so when you talk about it being ideal, what you're basically saying is price discovery was optimized. The bid-ask gaps were very narrow. But
yes, you'll hear this. Multiple studies out there will show this. That year was a great year.
Calm before the storm, I think it's called. Okay, so you guys were monitoring. Who are you selling the information to? Who's the consumer of Nanax information?
It's not the high. Well, we sell to anybody who wants information.
Who buys
real time. I'm sorry.
So who buys?
We have a very diverse group of customers, and that's primarily because we've never really marketed the product. It's more niche-like, but it's wide variety, all the way from individual click screen traders to large government bodies to retail brokers to really up and down Wall Street.
So what do they do with the data? So the data is after the fact. What do they do with it?
Well, some of them process it real time and trade real time.
Oh, okay. So
it's real time all the way down to historic. So we have one of the largest tick by tick databases in the world. We have options quote data, quote by quote, back to 2004. We're just coming up on a petabyte of information.
Petabyte is how many terabytes?
1,000.
Okay. Did your high frequency monitor precede the high frequency trading? Did you have the ability to see the tiny little ticks before they appeared? Or did
no, we were more looking at aggregate information. We did look at second by second message rates. That was kind of but it was grouped, so all stocks on this multicast channel per second kind of thing.
Okay. Okay, I have a better feel for what you guys do. That's since '86. Wow, that is interesting. What were you trained to do? What's your background?
Like I said, I started processing market data in the mid '80s. I self-taught myself the C language back in '85, I want to say. I actually had one of the first things I wrote was an automated trading system that bought and sold S&P 500 futures every 30 minutes, where the signal was every 30 minutes, and I would pick up the phone and I'd call Jack Carl Futures in Chicago and buy and sell.
Okay. So now we move forward. There's the flash crash, as you talk about, which in itself was disturbing at the time. Little known fact, I was actually quoted in the Wall Street Journal on the flash crash. Talk about going to the shallow end of the gene pool for information. I'm a chemist, in case people listening don't know this. So But I was quoted in an article they wrote about whether we were discouraged by the flash crash as standard investors. But there have been flash crashes all over the investment world now. So, for example, at one point, supposedly Berkshire Hathaway flash crashed to $1.
Right. That was right. That was it was interesting. It was but I think APC and Darko Petroleum, when it cratered from $90 all the way down to a penny, pretty much in small increments, seconds before the market closed. That was even more spectacular because Darko Petroleum, being the monster company it is, belongs to hundreds of indexes, and including the OEX and S&P 500, and that move really jolted the OEX price, which was right at the close. And there was a lot of that was option expiration day too, and a lot of options were mispriced because of that.
Yeah, right.
And they went back and they had readjusted Anadarko Petroleum's price, and they backed out almost a full buck out of the OEX after already settled.
But that in itself is a problem in the sense that the idea of backing out trades.
Oh, that's wrong.
Right.
That just never only for a retail customer should it be done. It should never be done by an exchange. Really, electronic. If your quote, if you're not going to stand behind your quote, there's no business being out there.
So then the other entertaining one. Some of these are just downright comical, like when Bats did their IPO and they sponsored their own IPO. And their own customers flash crashed them to zero within 900 microseconds?
No comment on that one.
Okay.
That's one of the few I've gotten nasty phone calls from.
Okay, well, anyone's welcome to call me and get nasty. I don't care. Okay. And now there's flash crashes in the Treasury market. They're not as deep, but they're scarier, and I bet you're about to show me a plot of one of those.
Right.
The Treasury, there is no market that's supposedly deeper than Treasuries. When that thing all of a sudden hits what on the surface, we'll call it superficially an air pocket. Oh man, I dropped acid before I did this, didn't I?
Yeah, there we go. So this is the different. The top one is the bonds, and then you've got the 10-year, and then the 5-year, and then you have your notes. And this right up to here is about the farthest you'd ever really see it back historically. So anywhere above here was into no man's land.
So what?
Wait, can I ask a question?
Yeah.
What's the time frame that we're looking at, Eric?
So this is 8:30 in the morning. This was the economic news at 8:30 here. This was when the U.S. stock market opened up. So you're talking
the high end of the interest rate scale. I can't quite see it. How high is it going?
3.5%. So this
right.
The price moved 3.5% on the bond.
And for non-bond traders, that's like that's a multi-sigma event right there.
Yes, it was. I thought I might have had a chart here that showed that in relation to the historically, but I guess not. It was a I think the equivalent of 3 months range in 15 to 30 minutes.
And these the recent Chinese companies that have been collapsing, are those by chance flash crashes?
Yeah, the Hanover one is interesting. I looked at that for the Wall Street Journal, and it was one of those rare times when they actually had my name in their article. They generally don't. They generally are reluctant to ever mention Nanax or my name, but they did this time, and Patterson did the article, and what it looked like happened to me was there was somebody who really wanted to get out and was selling fiercely, but there was also a large buyer at $7 who had a big bid out there, and kind of probably ended up coaxing a lot of others to just try to ride along, knowing that, hey, there's a big bidder out there at $7. I'll participate in this and see if I can make the spread or more, and the seller just kept selling. So that when that large on the bid side finally collapsed, all those opportunists just turned around and dumped, and then the price just evaporated.
So was Hanover Hanergy the one that it was the founder who was a seller? One of the companies, the founder tried to
monster
get
seller. Yeah, it was a seller who was just, dump it kind of thing. He was just dump it. He sold a ton, very aggressively.
Yeah, it's like the GoTo.com guys. They got criticized for exiting their own stock by Wall Street, when in fact they were the guys who knew that it was just a total, utter piece of garbage, and they were just trying to.
What's interesting is his selling rate was what I expected to see in the data after I got Waddell & Reed's order execution data. I got that after the SEC did their report, and reading the SEC report, my anticipation was something like the Hanergy, where it was just wholesale dumping.
Oh, that's okay. So that's that's just an accident.
That's real wholesale dumping.
Well, as opposed to something where it's a very low volume, complete and utter collapse, right? That sounds like someone wanted out of too many shares in too short a time.
Yeah, that market held up very well. I was really impressed by how the bids actually stayed there. They didn't really disappear. It
didn't break. It didn't break.
Everybody who posted to want to buy was able to buy, and they didn't change their mind.
Did you by chance? I bet you.
Hey, Dave. I like to move this to what Eric had posted early, that he was going to show the Hillary cattle trade. Let's move to that.
Get to Hillary. I can talk about Hillary all day long.
Indeed.
There we go.
Cattle trade, Eric. I'd love it.
All right, here we go. So I still have not been able to get intraday data, but this is enough to really show. You'll get the idea in a second. Okay, so this is daily data. This is the December 78 contract, and each one of these is one trading day. They're candlesticks. I use that so that you can tell where the open and close was. These 2 days here are the subject days involved. So this is supposedly her first trade. The ink is still drying on her account. I think, according to one of the news sources, was even filled out with wrong information. But nonetheless, she gets her account and open that day and sells that day 10 cattle contracts. And she sells it on this first day here, and she ends up getting a sale off just 7 cents, 6 or 7 cents off of the high. Very impressive. That's where her short was. And then the next day, she covers it, and she gets, within 12 cents of the low of that next day. Very impressive trade.
So what would be, 10 contracts, that drop, what kind of profit are we talking about? Round
63, that was 5,800.
Right.
And her commission was $500. So she netted 5,300, and she opened her account with $1,000, which I believe is well below what the margin would have been back then.
She ended up making 100,000 off 1,000, so she ended up making 100 bagger off cattle trading, which she's kind of a bullshit artist, so maybe she knows cattle, right?
It wasn't so. You're right. So when I first read those, I thought it was just like she bought when the prices were really low and she sold when the prices are really high, and that was that. But no, apparently it's a lot of these little trades like this, and which is really quite fascinating. I mean, for all we know, Hillary's a futures trader.
Well, now but an article came out recently which someone has been fingered having been the guy who stacked her account with all the winning.
Redbone, like Redbone or something like that.
Yeah. So
he was actually disciplined and was banned from the CME for 3 years, which is
exactly.
And all the fines I've seen, I've never seen anybody get. I think the worst was Panther Energy, which got banned for a year. This guy got banned for 3 years, and what he was doing was he was assigning trades to accounts after the fact, so he could put the winners in this guy's account and losers in this guy's account.
So it would be like another way you could do this, I've thought about it, is if someone wanted to give Hillary a ton of money, you could set up a deal with a casino owner who's willing to play along. You could go in and just throw $1 million away at the casino and have the guy agree to then donate to the Clinton Foundation that $1 million, right? You could
sure.
Launder the hell out of it. And, we know that those guys will accept contributions from any source. We should get there eventually.
Right. I mean, there's nothing preventing that from happening today either. I mean,
it is happening today. No, there's no.
Right. But I think the more civilized way is where they pay an obscene amount of money for them to speak at their event. Like I was thinking about the Sparkle Ballroom event that Credit Suisse recently had, and I think Bernanke was there, and Mary Shapiro was there, and
this is great. I love this stuff.
Yeah, the Sparkle Ballroom in Miami. It's just,
a party.
So
it was payback.
For those who are unfamiliar with this, you should crawl up from underneath your rock for starters. But basically the way Hillary has done this is that so this guy Schweitzer wrote a book called Clinton Cash. Before reading that book, which I finished a couple weeks ago, I prefaced it with a book I thought would be important preface called Sociopath Next Door. And so what happens is that after presidents leave office, they get to give speaking tours, and it kind of starts with if a president goes to Saudi Arabia, gives a speaking tour, and gets $1 million a speech. Any future president's going to think twice about pissing off the Saudis, right? So it's called soft corruption. Now, what normally happens is that, can you guys hear me? Because I just saw Bob go blank.
Oh yeah, I hear you great.
So what happens is it's called soft corruption. You can't find a quid pro quo in there. You know it exists, right? The Saudis don't give people $1 million for laughs. And so what happens is it tapers as the person finishes their presidency, and after a while they're worthless. And they get their payola, their kickbacks, and then they go into retirement with a lot more money than anyone could have imagined. Bill, when Hillary became Secretary of State, his speaking fees soared to the moon. Right, spectacular. He got up to $750,000 per speech. Some of these speeches were to a room full of a dozen people. And so they're just kickbacks. It is so garishly corrupt, and he's getting kickbacks from Nigerian warlords, and I just read an article this morning from Arizona State University, and the author of the article says this is appalling that Arizona State paid Hillary $200,000 to speak when they're raising tuition. And the author had no idea that she's going to kick back millions in federal grants and aid, and that the whole thing's a quid pro quo. She kicked back millions to the for-profit colleges. So what I can't fathom at this point, I've read a ton about Clinton Foundation, it is so openly corrupt. And yet Hillary still has followers, and I don't get it. She started. By the way, the Hillary corruption traces further back. When they were in Arkansas.
Are you there? You just dropped out.
Uh-oh, Dave locked up. Have no idea. He must have been ranting and raving so much.
Yeah, you got the NSA out.
Well, but Eric, I think you were putting out such great things with that cattle trade, and I want to move on with you. Oh, David seems to be back. Dave,
I think.
your rant went so far that you blew up the system.
Oh, that's happened before.
You know what, my take on all this is people just don't like to think. You know, they're already overloaded as it is with their own problems in the world, and you know, and I guess maybe it's one of these: the devil you know is better than the devil you don't.
Oh boy. Sure.
You know, I could definitely, you know, I'd rather see Bill run than Hillary. I mean, that guy was
Right.
he was just entertainment. Just I certainly didn't vote for him, and I did not want him to be president. But you know, after the fact, I truly enjoy watching his antics.
Right. Yeah, I find him appalling, but I find Hillary repulsive.
Yeah, I don't get her. I don't understand. Right. So anyway, I think that's what's happening is people just it's hard for them to really conceive just how corrupt it is.
And yeah, so they've earned 150 million on these speaking fees, and you know, I realize, and it was actually a pretty recent click in my brain that being Secretary of State was the best fundraising position possible because she knew she was running for president. She could travel the globe setting up deals between multinationals and sovereign states. Her 10 biggest donors are sovereign states, with Ukraine number one. How can that possibly be valid, right? We're in this global conflict that could turn into World War III, and Hillary's taken donations from one of the players. And the feminists support Hillary, and her number two donor is Saudi Arabia. There's a capital of feminism for you, right? They're lopping off women's heads in that place for committing adultery, and so it's mind-boggling. I want to take you another direction. It goes back to high-frequency trading. It's an interesting story. Tell me what you know about the Aleynikov story.
Aleynikov.
Yeah, Aleynikov, the Goldman trader. This almost kicked off the
that
trading.
Yeah, that's you know, it's very disappointing to me. I mean, the ability of Goldman to really basically take up what should have been a private matter and involve the FBI. I mean, that's kind of silly. I certainly couldn't do that if one of my employees I suspected. There's no way I could get that kind of service. You know, bright programmers would never steal code in the first place.
Yeah, it was open source almost.
It's just the knowledge. You know, the knowledge that it's possible is a big step. Having done it once, you would never do it the same way again the second time around because you already know of bunches of ways that you would do it better. So it just doesn't make sense that he would want to steal their code.
So he didn't make a penny.
And the thing that really gets me though is that, you know, Goldman, maybe this is hyperbole, maybe it wasn't, but you know, they were, you know, trying to justify what the extreme measure they did to go after this guy. And what they said, this code can manipulate the markets, and you don't want that in the wrong hands. And I'm thinking,
is that great?
Well, yeah. So it's in your hands, and it wasn't just me who picked up on. A lot of people picked up on that, but I can tell you that the chief economist at the CFTC picked up on that.
Well, in
the summer of 2010, and whatever happened.
So the attorney for Goldman, who, by the way, probably shouldn't have been in court in the first place, should have been a prosecutor, the attorney for Goldman made that case in court. That's why he wanted Aleynikov not out on bail. He used the argument that he could manipulate the markets with their code. And so Michael Lewis did a great story, which I can't post a reference to, which I have, but in which he really went through the Aleynikov case in detail, and he basically describes the guy who didn't even realize that he supposedly stole the code. There was no nefarious idea at all in his skull.
Right. I mean, it was a lot of it was open source too. It just wasn't. It wasn't the secret sauce. It just, I don't know. It was very eye-opening. I think the other very parallel case that's also equally eye-opening is what's happening with Sorrow, if I'm pronouncing that correctly. I mean, that guy's essentially got thrown away.
Right, and he's doing this from his parents' sofa in the basement, right? I mean, so to back it out, the Sorrow guy, since I don't know who listens to the show and what they know, but Sorrow just got indicted for high-frequency trading, and now they're blaming, what is it, Dylan Reed, supposedly, was the first culprit of the flash crash, and now they're hanging that on Sorrow, and he literally was trading from his basement in England, and they somehow have claim that this Indian guy in his basement. By the way, I don't think it's just a coincidence. I think they like to go after foreign guys.
Right. That's a common theme.
Oh, like in the Galleon guys, right? Rajaratnam. They get the xenophobic kick out of that. And
well, I'm not sure it's xenophobic. I think it's they're afraid, and it's kind of insulation for them because it's one layer of remoteness where it's a lot less likely that they're going to fight back.
Oh yeah, it's like the IRS. They'll go after little guys. So I had an interesting experience where when Aleynikov broke, and again I got to give Zero Hedge a hat tip. These guys are way out ahead. Now the journalists are reading Zero Hedge, so they're only a little bit out ahead. But So Zero Hedge wrote about this Aleynikov guy, and at one point I'm watching Jonathan Weil, who's a good journalist, and he got interviewed, and they asked him about Aleynikov, and he just dismissed it. And so I sent him an email, and I said, Jonathan, I think there's more to this story than you're giving it credit. And he says, well, what do you think's happening? I said, I think the software is used to front-run trades. This is before the HFT story seemed to bust wide open. And he said, really? And so then the next day, he must have done a lot of homework overnight, because the next day he called for an investigation in an article he wrote. And I'm thinking, boy, that was fast action. Here's the
question. It was never investigated. It was never. It never went anywhere.
So I want to ask you about the people who were most hurt by the HFT guys. Let me put forth an idea, and you tell me what's right or wrong. So Joe Sixpack makes a trade, and there's some bid-ask gap. Let's call it an 8, or let's call it 10 cents, or whatever you want to do. And so some guy like Saluzzi, maybe, go back to him, someone's pocketing that 10 cents. And my thought is that it's not so much the little guy is getting his money stolen, but the bulk traders on Wall Street are getting their money stolen. What's wrong with that idea?
So they're both getting their money stolen, and you're asking
if I pay the same bid-ask gap as I always would have, but the guy who's trading for me, instead of him getting the 10 cents, some high-frequency trader jumps in and grabs it from him. Then I would.
Right. So if you don't want to take advantage of all of what the market could be, if you just want to keep your head stuck in the mud in the past, that's a great way to look at it.
Well, I'm just trying to figure out if I'm actually hurt.
Imagine if Amazon ran the stock market. Imagine what your brokerage statement would actually look like. You would actually get to know exactly why it executed the way it did. There would be an audit trail. There wouldn't be any question when a stock crashes of who did it.
Yeah, I'm less interested in the crashes right now. I'm more interested in the idea that the high-frequency guys are jumping in and scalping that narrow profit margin that someone else might have gotten. Is it possible that the retail guy is not the one paying the price, in a sense that it's the big bulk traders that are paying the price? Is that right?
No, the retail guys are So if you want, here's the secret to not being screwed the least. To be screwed the least, trade small amounts and use market orders. If you use a market order, you're going to very likely all your buy orders are going to be priced with ending in 4 digits, and the last 2 digits will be 9 nines. And if you're selling, they're always going to be 4 digits, and they'll end in a 0 1, because what's happening is the market maker, quote unquote market maker, is jumping in front of the limit order that some other schmuck has placed.
Right.
And so you're going to get your trade done. You're going to pay just a tiny amount less than what the spread is, which is awesome. Thumbs up. And as long as your size is small, they're not going to mess with you. If you try to do a limit order, though, watch out. If you try to put in stop orders, watch out.
So the small size keeps it below the radar of the high frequency guys who will bust up a big trade.
No, so right. So as long as the size is smaller than or equal to or smaller than the size advertised at the exchange that has the best quote.
Right.
And this isn't always 100%. So if it's 100 shares, you're pretty much fine all the time. Once you start going over 100 shares, then you have to kind of pay attention to what you're buying and selling.
So you want to do round lot tiny. That's interesting. So that answers that.
So let's look up from 10,000 feet. Are you trying to tell me that things are better knowing that?
No. I hate the corruption, dude. I'm just trying to figure out who's actually losing the money.
The ones right. So the ones losing the money are the ones who are doing everything else.
Say that
putting the limit orders in, trying to buy large amounts, trying to buy large amounts with the limit order.
Scalped.
Have a stop order in.
Yeah. And that's where Katsuyama's model, where he puts in delays so that the HFT guys can't pick up on the big trade. That's where he stepped into the game. Is that right? So,
right. So he realized. So one of the big problems is if you want, say, there's 20,000 advertised of Ford, and you want to buy 20,000, but the problem is the 20,000 is split up amongst, say, 5 exchanges.
Right.
You've got to make sure that you time it so that the smart order writer will send it exactly within microseconds, and gets to each exchange engine within that time frame. That's what he developed to get around that one particular problem.
Right. So Katsuyama would send 5 trades to 5 exchanges with just the right timing, so they all arrive simultaneously, so that the HFT guys couldn't respond to one exchange by going to the other exchange. Is that right? So yes, correct. So the anti-Thor solution is to introduce random delays on different systems, because that timing is only good if the systems are running at a known benchmark rate. So if all of a sudden they're processing an extra 1,000 bogus orders a second on another stock that is on the same group, their timing is now going to be thrown off. Okay, so now let me ask you this. There are assertions out there, which might be by guys who know what they're doing, or might be by guys who are trying to dismiss the problem, that that the high-frequency traders at this point are cannibalizing themselves so much that they're out to 5 decimal point scalps, making 10 cents on trades on Berkshire, and that they're essentially they're going to put themselves out of business. Is that too optimistic?
What was that big IPO we just had?
Oh boy, Facebook.
So that's not what I heard from the IPO roadshow.
Okay. Well, IPOs, so I don't even get the IPOs because you're not.
I'm talking about Virtue, the king of high frequency. So they were telling people opposite of what you just described.
Yeah, but they could be lying, right? Seems to me they could be lying. It wouldn't be the first time they lied in an IPO.
We don't see a difference in metrics. For example, the percentage of trades that execute at the de minimis amount of 1/100th of a cent is still a very constant. 1/3 pretty much of all price improved or sub-penny retail trades.
Mm-hmm.
I think what's happening is it's concentrating in fewer. It's still the same profit. It's just concentrating in fewer hands who are much better about massaging the message and not talking about. So I mean, what would you expect them to say? Oh, our profits have never been better.
No. Well, I was trying to figure out if that was the statement of someone who actually saw their demise with glee, or it was them claiming, "Don't worry about us, we're going away anyways." I got to bring up a couple things. One is when I read Flash Boys, I couldn't. Michael Lewis has a habit of doing this. So he writes Liar's Poker, and he thinks he's denouncing Wall Street. It turns out there was this gigantic spike in people wanting to go to Wall Street because it sounded exciting to them. He writes Flash Boys, and the analogous response that I sort of had was I had this sort of odd view of the cleverness of the HFT guys, the guys putting in the guys who ran the cable from Chicago to New York, and the technology. I'm looking at this, I'm going, okay, these guys are criminals, but they're so smart. I mean, I was in awe of the cleverness. Have you heard that, or is that just nutball me?
No, I definitely appreciate the ingenuity in getting information from point A to point B faster. That's awesome. I mean, I think that's great. It spills over into the rest of civilization, and because they work out the bugs of how do we communicate faster. I mean, maybe one day we'll need that when the aliens come and we have to fight them, but we've got this ability now, or who knows what. But I mean, it advances civilization by them doing that. But the problem is a lot of what goes on is our backdoor deals.
Oh, I totally.
And that is like the worst thing for a smart guy when he wants to figure out what he wants to do in his life. If there's behind door number A, I've got to know all these secret handshake deals, and I got to pay off these people so I can do that, and I might get charged in the future, and that's a regulatory risk. No, smart guys don't want to hear any of that business. They would much rather transparency is what brilliant people like to work on.
So Hayek once said that that he could handle rules. Some people view him as almost like anarchist libertarian, but he's not. And he said something to the effect, he could handle rules. He could handle arbitrary and bizarre rules. What he couldn't handle were the changes. So he said the system will adjust to goofy rules, and it's the constant changing that makes it very difficult. So, for example, as you're saying, the investor doesn't know how to invest now because you have no idea what's coming.
There's no way to find out what's happening either. I mean, I've been working with this one retail person who's been kind enough to execute trades through Schwab, and just the most ludicrous things we hear back as explanations for why something didn't fail or got just clearly getting screwed. And the people at Schwab, I believe, honestly, do not know what's going on either. And it's not that I could handle crazy rules. I can handle crazy rules that change every year. I can't handle rules that are unevenly applied.
Right.
Like, why is Tharo in jail and another high frequency firm, the one that HTG is suing for doing the same exact thing in treasuries, 6,000 documented instances, they're out, they're out and free. I'd also be fine with the Wild West where there are no rules.
Right.
We've got rules out there, and nobody really knows what they all are, and nobody that rule, you violate that, you may be the rest of your life in prison, or it might be a $5,000 fine. Here's the roulette wheel. Who wants to do business in that environment?
No one. So this gets us to the question of systemic risk. The thing that bothers me to no end is that the high frequency trader shenanigans, they're going to make a ton of money. It's not fair. You could argue that maybe since the dawn of civilization, this kind of gaming has gone on, and there's been slavery and there's all sorts of crap. But I'm just trying to not. So I think of it as the system as a metaphor, as an anthill. And you could go out and step on the anthill all day long and stomp on it and beat on it. And the next day you came out there, there'd still be an anthill. So the system has a kind of a durability. But what I'm trying to be is not one of the goddamn dead ants, right? Because during this durable evolution, a lot of dead guys along the way. And so my concern about HFT guys is that they will destroy the system. How concerned should I be that they manage to bring it to its knees so badly that we get gutted?
Well, I mean, we're already at that point where you have Anadarko Petroleum going from $90 to a penny in seconds. And one of the things I like to ask people when I speak at places, if they're investment fund managers or people who trade, I'll say, well, how many bought Anadarko Petroleum at a penny? How many bought it at 10 cents? How many would buy it right now, sight unseen, no matter what possible news could be? Who would pay 10 cents for Anadarko Petroleum right now? Can't look at the news. I bet every single person on planet Earth would take that deal.
So
but yet nobody did take that deal.
It bounced
back. Why did it go from 10 cents to a penny?
Did it bounce back?
It's because there's the number of participants goes to a very small number whenever the machines start revving up and go beyond a certain speed.
Yeah, it's duck and cover. You go into your desk. And you can't because it's so fast. But the number of these flash crashes bounce right back. My concern is we're going to have that day where the rebound's not going to exist. Is that a valid concern?
Well, when it's thundering and lightning outside, do you stay in the house, or do you not care if you get hit?
No, well, that's what I'm doing.
You have a much better chance. You have a much better chance of getting caught in one of these things than getting struck by lightning. So, I mean, you cross the street with abandon, but yeah. So Anadarko Petroleum hiccuped on that one day, but you know what? There were people who actually got screwed that day.
Oh yeah, yeah.
And so, not just in that stock, but in the OEX options. I mean, people are getting screwed when these things happen. There's just not enough screams to really register high enough for anybody in the mainstream media to take notice.
So those are the dead ants on the anthill, right? Those are the carcasses that the next day there's an anthill.
Well, right. So your analogy is going to fall apart here because what should happen is there should be one large winner at the end because it comes down to scale. So if the larger you get, the more you can amortize your costs across multiple instruments, and you'll be able to make those trades in stocks for a fraction less than the next guy. And you should, at the end of the day, there should be one winner.
Yeah.
Well, guys, we're gonna have to bring this to a close at this point. Eric, this has been transformational. And David, thank you both. But I just don't want to go on endlessly, online here. So I do want to end this, but I'd like to invite you both back, and even if we do it next week, whenever, I'm more than open.
Well, that'd be great for me. I like this. I had so many questions I was dying to get answered in more than 140 characters, and so I really appreciate Eric showing up on the show, and I am well aware that many a media person has tried to get him, and so we're very lucky to get him here. And
I can't agree more, David. Thank you, Eric, so very much for your time and your expertise. It's unbelievable.
Well, it's my pleasure. Thank you for having me.
So I'm going to look you up, by the way.
Can we do this again?
Yeah, I'm always.
Yes.
I'm always,
Sure.
Sounds great. We'll talk offline, guys.
All right. Thanks,
Signing
guys.
off now. Bye.